Most people think a loan is just money you borrow. It's not. A loan is renting money, and the rent you pay for it is called interest. How much rent you pay and for how long depends entirely on which type of loan you're looking at. I'm going to walk you through every major type of loan in the US, how each one works, what it's actually for, and at the end, I'm going to show you a number that will change how you think about borrowing for the rest of your life. Stay for that. Let's start with the basics. Every loan has three parts: the principal, which is the amount you borrowed, the interest rate, which is the cost of borrowing it, and the term, which is how long you have to pay it back. These three things, principal, rate, and term, determine everything. Change any one of them and your total cost changes significantly. Most people only pay attention to the monthly payment. That's a mistake. The monthly payment is designed to look manageable. The total cost is where the real number lives. Loans are also either secured or unsecured. A secured loan is backed by collateral, something the lender can take if you stop paying, like your house or your car. An unsecured loan isn't backed by anything except your promise to pay and your credit history, which is why unsecured loans almost always come with higher interest rates. The lender is taking more risk, and they price that risk into the rate you get. Speaking of credit, your credit score is the single biggest lever you have over what interest rate you'll be offered on any loan. The difference between a 680 credit score and a 760 credit score on a $30,000 auto loan can easily be 3 to 4 percentage points, which adds up to thousands of dollars over the life of the loan. We'll come back to this. Understand that improving your credit before you borrow is almost always worth the wait. The first type is a mortgage. A mortgage is a loan used to buy real estate, and it's secured by the property itself. If you stop paying, the bank can foreclose and take the house. Most mortgages in the US come in two main structures: a fixed rate mortgage, where your interest rate never changes for the life of the loan, usually 15 or 30 years, and an adjustable rate mortgage, where the rate is fixed for an initial period, often 5, 7, or 10 years, and then adjusts based on market conditions. Fixed rate mortgages are predictable. Adjustable rate mortgages usually start cheaper, but carry the risk of your payment increasing later. There are also government-backed mortgage programs worth knowing. FHA loans are insured by the Federal Housing Administration and are designed for buyers with lower credit scores or smaller down payments. You can qualify with as little as 3.5% down. VA loans are available to eligible veterans and active duty military, and they come with no down payment requirement and no private mortgage insurance. USDA loans are for buyers in rural areas and also offer zero down payment options. These programs exist specifically to make home ownership accessible to people who wouldn't qualify for a conventional loan, and millions of people use them every year without knowing they were an option. One thing that surprises most first-time buyers is private mortgage insurance, or PMI. If you put down less than 20% on a conventional loan, the lender will require you to pay an extra monthly charge that protects the bank, not you, in case you default. PMI typically runs between 0.5% and 1.5% of the loan amount per year. On a $300,000 loan, that's anywhere from $125 to $375 per month on top of your regular payment until you've built up 20% equity in the home. The second type is an auto loan. This is a secured loan used to buy a vehicle, with the car itself as collateral. Auto loans are shorter than mortgages, typically 3 to 7 years, and the interest rate you get depends heavily on your credit score. Here's the part most people don't think about. Cars lose value the moment you drive them off the lot. A new car can lose 15 to 20% of its value in the first year alone. That means for the first few years of a long auto loan, you can actually owe more than the car is worth. A situation called being underwater. If the car is totaled or stolen while you're underwater, your insurance pays out the current market value, not what you owe. That gap comes out of your pocket unless you have something called gap insurance, which covers the difference. Dealerships also often mark up the interest rate on financing they arrange. They get a wholesale rate from the lender and sell you a higher rate, keeping the difference as profit. Getting pre-approved by a bank or credit union before you walk onto the lot is one of the most effective things you can do. You walk in knowing exactly what rate you qualify for, and the dealership either matches it or loses the financing deal. It's a simple step that most buyers skip, and dealers are counting on that. The third type is a personal loan. Unlike a mortgage or an auto loan, a personal loan is usually unsecured, meaning there's no collateral backing it, and you can use the money for almost anything. Debt consolidation, medical bills, home repairs, a major purchase, or any large expense you need to spread out over time. Because there's no collateral, personal loans carry higher interest rates than secured loans, typically anywhere from 6% to 36% depending on your credit. But they're still almost always far cheaper than carrying a revolving balance on a credit card. If you're sitting on $8,000 in credit card debt at 24% APR, rolling that into a personal loan at 12% and paying it off on a fixed 3-year schedule will save you a meaningful amount of money and give you a clear payoff date instead of a minimum payment that barely moves the needle. One thing to watch for with personal loans is origination fees. Some lenders charge an upfront fee, typically 1% to 8% of the loan amount, just to process the loan. That fee is often deducted from your disbursement, meaning you borrow $10,000 and receive $9,200. Always factor origination fees into the real cost of the loan before you sign. The fourth type is a student loan. Student loans come in two forms: federal loans, issued and backed by the U.S. government, and private loans, issued by banks or other lenders. Federal loans almost always have better terms: fixed interest rates set by Congress, income-driven repayment plans that cap your monthly payment as a percentage of your discretionary income, deferment and forbearance options if you lose your job, and forgiveness programs for people working in public service or certain nonprofit roles. Private student loans are underwritten like any other personal loan based on your credit and, if you're a student without a credit history, often on a co-signer's credit. They don't carry the same flexible repayment protections. There's no income-driven repayment. There's no forgiveness pathway. And the interest rates can be variable, meaning they can go up. One critical thing to understand about student loans, federal or private, in almost all cases, they cannot be discharged through bankruptcy. Congress made that change in the 1970s, and it has never been reversed. That makes the decision of how much to borrow for school one of the most consequential financial decisions a person makes before they've even earned their first paycheck. A useful rule of thumb: try not to borrow more in total student loans than you expect to earn in your first year out of school. If you're going into a field that typically pays $50,000 to start, borrowing $80,000 is going to create a repayment burden that follows you for a decade or more. The degree matters, but so does the math. The fifth type is a payday loan. I'm including this one not because it's useful, but because millions of people use it every year without understanding what it actually costs. A payday loan is a short-term, high-fee loan, typically $200 to $500, that's due back on your next payday, usually in 2 weeks. The fees are framed as flat charges, $15 to $30 per $100 borrowed. That sounds manageable. What it translates to in annual percentage rate terms is between 300% and 600% APR. If you can't repay in 2 weeks, the loan rolls over and the fees compound. Payday loans are legal in most U.S. states and marketed to people in financial emergencies. They are consistently one of the most expensive ways a person can borrow money. If you're in that situation, a credit union emergency loan, a paycheck advance from your employer, or even a credit card cash advance, despite its high cost, will almost always be cheaper. Now, Here's the number I want you to hold on to before this video ends. Take a 30-year mortgage on a $300,000 home at a 7% interest rate. Your monthly payment will be a little over $1,900. By the time that loan is fully paid off, you won't have paid $300,000. You'll have paid more than $718,000. You will have paid for that house more than twice. And in the first 10 years of payments, the majority of every single dollar you send to the bank goes toward interest. But the term of a loan and the interest rate attached to it are not background details. They're the most important numbers in the entire transaction. The bank runs this math before they offer you anything. You should run it too. If the numbers in this video surprised you, there's a lot more where that came from. Hit subscribe. Next time, it gets even more interesting. Thanks for watching. See you in the next one.